สำหรับวิทยากรของเรานะคะในเซสชันนี้เนี่ยเราได้รับเกียรติจาก2ท่านแรกก็คือทางคุณ Daniel Fineman นักวิเคราะห์หลักทรัพย์และนักวางแผนกลยุทธ์บล.เกียรตินาคินภัทระส่วนอีกท่านหนึ่งค่ะก็คือคุณฟิลิปฟินช์นะคะคุณฟิลิปฟินช์ก็ทำหน้าที่เป็นหัวหน้าทีมกลยุทธ์การลงทุนหุ้นไทยที่บล.เกียรตินาคินภัทระจำกัดมหาชนค่ะในส่วนของวิทยากรทั้ง2ท่านนะคะต้องเรียนว่าเป็นกูรูในอินดัสทรีนี้แล้วก็มีประสบการณ์ทำงานอยู่ยาวนานกว่า20ปีนะคะโดยที่ทั้ง2ท่านเนี่ยมีแบ็กกราวด์แล้วก็ specialization เกี่ยวกับหุ้นโดยเฉพาะหุ้นไทยแล้วก็หุ้นในภูมิภาคของเราด้วยทั้ง2ท่านเนี่ยก็ยังมีประสบการณ์การทำงานอยู่ใน global bank ระดับโลกด้วยนะคะสำหรับตัวหัวข้อของ Thailand and the World the Year Ahead นะคะที่เราจะว่ากันด้วยเกี่ยวกับเรื่องของหุ้นไทยเนี่ยจริงๆแล้วในช่วง 1-2 ปีที่ผ่านมาเราเห็นเรื่องของ divergence ของผลตอบแทนระหว่างตลาดหุ้นไทยกับหุ้นโลกชัดเจนเหมือนกันนะคะยกตัวอย่างเซสชันเมื่อสักครู่ที่ทางดร.พิพัฒน์แล้วก็คุณทวีศักดิ์ได้เล่าให้ฟังไปคร่าวๆทีนี้เนี่ยเข้าใจว่าหลายๆท่านก็มีคำถามนะคะว่าตัวของหุ้นไทยเนี่ยจะมีเทรนด์เป็นยังไงบ้างในเซสชันนี้เราก็จะมีความพิเศษนะคะก็คือเราไม่ได้มองแค่ในเรื่องของ outlook ของหุ้นไทยอย่างเดียวก็จะมีพาดูด้วยว่าเปรียบเทียบกับภูมิภาคของเราเนี่ยหุ้นไทยตัว position อยู่ตรงไหนนะคะ
สวัสดีครับทุกคนครับผมชื่อฟิลิปฟินช์นะครับฟิลิปทำงานเป็นหัวหน้าแผนกหรือทีม Equity Solution ฝั่ง Wealth Management ที่เกียรตินาคินภัทระนะครับฟิลิปดีใจมากๆนะครับที่ได้มีโอกาสมาคุยกับทุกคนนะครับวันนี้ฟิลิปจะคุยเรื่องตลาดหุ้นทั่วโลกนะครับแต่จะเน้นเฉพาะตลาดที่ emerging markets หรือ EM นะครับหลังจากคุยเสร็จนะครับจะชวนคุณแดน Fineman มาคุยเรื่องตลาดหุ้นที่เมืองไทยนะครับแต่ฟิลิปจะขอรบกวนทุกคนนะครับจะขอ present เป็นภาษาอังกฤษนะครับเพราะว่าฟิลิปยังพูดภาษาไทยไม่ค่อยคล่องเท่าไหร่นะครับ So this year for global equities, I think there are 4 main macro trends that we should be following. จุดแรกนะครับคือเศรษฐกิจทั่วโลกนะครับน่าจะโตช้าลงนะครับปีนี้ So if you look at the table here, based on consensus estimates, you can see that GDP growth globally is going to slow from 3% last year to 2.6%. But this is actually temporary because the expectation is that by 2025 we go back to around 3%. Now, if you look a little deeper here, that you can see that growth is pretty uneven. Economic growth in the US is actually going to slow to around 1.3% from 2.4%, but then recover a bit next year at 1.7%. In emerging markets, actually, we're now looking for economic growth to be a bit stronger this year compared to last year, although China still looks to be pretty subdued, so weaker growth this year and remaining weak next year. จุดที่2นะครับสำหรับ global macro trend คือเงินเฟ้อจะลดลงนะครับ so we've actually seen evidence of this. If you look at this chart here, global inflation, US inflation, peaked at around 8% last year. It's coming down pretty quickly. And I think, as we move through the course of this year into next year, inflation is going to be, under control. Maybe US inflation moving towards 2% target quicker than people were anticipating. จุดที่3นะครับคือดอกเบี้ยทั่วโลกน่าจะเริ่มลดลงปีนี้นะครับ and the country where everyone's focusing is the US, where rate expectations have shifted dramatically in the last 2 months or so. This table here, or this chart here at the bottom, is based on the Federal Reserve's so-called dot plot. And what it shows you is that the Federal Reserve's expectations where interest rates in the US could go to. For me, what's interesting is that this year, the expectation is that we're going to get probably 3 or 4 cuts, which is less than what the market has been pricing in. The market has been talking about 5 or 6 cuts, which I think is too optimistic, more likely around 3 or 4%. But then if you look next year, they're looking at another maybe 4 cuts, and the year after another 4 cuts, and then settling at around 2% by 2027. Now, why is this important for me is because it suggests that we are at the start of a multi-year down cycle in interest rates. And that's important not just for global economic growth, but also for corporate profitability. And if this is accompanied, these cuts are accompanied by lower bond yields, and we've seen bond yields come down in the last 3 months or so, which implies lower cost of equity, well, that should be good for share prices as well. So this for me is really a very supporting factor for global equities. อันข้อที่สี่นะครับคือพูดถึงค่าเงินเหรียญว่าจะอ่อนขึ้น So we've seen since late October last year, around here, that the dollar has weakened against various currencies. In the last 2 or 3 weeks, it's actually reversed a bit. But since late October, the dollar has weakened on average around 4 to 5%. And we think this trend could continue with further rate cuts, with a weaker GDP growth in the US, and possibly higher government debt levels in the US, especially if Donald Trump gets re-elected, then there might be some concerns on the fiscal front. So focusing on the theme of dollar weakness, what is the best way to play this going forward? We think the answer to that is through emerging market equities. You can see from this chart here that there's a 73% correlation in the last 20 years or so between the performance of emerging market equities, and which is MSCI EM, as well as emerging market FX. Now, that relationship is an inverse relationship to the US dollar. So what tends to happen is in periods where the dollar weakens, stock markets in emerging markets tend to go up. Now, since the year 2000, we have had 12 episodes or 12 periods of dollar weakness. And our definition of dollar weakness is where the dollar weakens by 10% or more within a 1-year period. On average, the dollar weakness was 11.7% during these 12 episodes. So this would be one episode, another episode, and the current one is here. So it's down about, the dollar's weakened by about 4 or 5%. Now, during these 12 episodes, emerging market equities went up 42% on average. And you can see here on this chart, across different asset classes, EM equities did the best. You know, compared to developed markets, which is this one, MSCI ACWI, which did do well as well, up 26%, but that still underperformed EM by 16%. Versus gold, EM did better, versus other regions, FX, EM equities still did better. Now, in the current episode, where the dollar is weakened by about 4 or 5%, EM equities are up only 7%. We think that could continue much further. Now, I've highlighted here 4 reasons why EM equities tend to do better in periods of weak dollar. One is a flow argument. When you have dollar weakness, you tend to see flows going out of the US looking for returns that are higher. Secondly, you get potentially an earnings boost, especially for countries or companies that export commodities that are linked to the US dollar. So if you think about it, if the dollar price of a certain commodity is coming down, then for foreign investors or for buyers outside the US, in their local currency terms, it's cheaper. That tends to drive demand and push up commodity prices. Third would be the fact that for countries or companies with US dollar denominated debt, then obviously a weaker dollar would lower that debt burden. And generally speaking, global risk appetite is typically enhanced or associated as rising in periods of weak dollar. So if emerging markets on average go up 42% during past periods of weak dollar, which countries should we be investing in? And you can see here that countries like Brazil, Argentina, Peru do particularly well. On the opposite end, countries such as Saudi Arabia, Malaysia, these are countries that do still quite well, but not as well. You can see that in Thailand for the Thai equities up 38%, so slightly less than the emerging market average of 42%. Now, if you strip out the dollar effect, then in local currency terms, on average, Thai stock market went up 29% in periods of weak dollar. By sector, we're talking about the materials sector doing particularly well, consumer discretionary and energy, whereas healthcare and utilities tended to underperform in periods of weaker dollar. And then lastly, in terms of investment styles, so just explaining the table a little here, it's a bit complicated. So these are the different episodes. We had 12 episodes. You can see that the date of them, how much the dollar weakened in each episode to get to the average of 11.7. And then within these different episodes, how did the different investment styles do? So we found that momentum as an investment style did particularly well. So it was up about 52%. So for those who don't know or are not so familiar with the momentum investment style, effectively it's where you focus on stocks that have recently shown strong performance. You just stay away from stocks that are falling. But it's a bit short-term in nature in terms of this investment style. So just to wrap up, what's the investment conclusion from periods of weak dollar? Well, first of all, EM typically outperforms DM. So emerging markets outperform developed markets. These are the countries that tend to do better, Brazil, Argentina, Peru, and these are the countries that do less well. In terms of sectors, materials, discretionary, energy, industrials tend to outperform communication services, staples, healthcare, utilities. And in terms of investment style, momentum, growth, small caps usually are the winners. So just to wrap up, this analysis very much supports our overweight stance on emerging market equities. That's a call that our CIO office made in their year ahead publication. So if we do see further periods of dollar weakness going forward, that should be positive. And as you may have heard from Kun Tuisak, within that, China, we have a neutral weighting, but clearly outside China, we are clearly very positive. And we also have within wealth management at Gietnakin Patara, a tactical overweight on Thai equities. And this analysis clearly supports that as well. But let me stop there and hand over to Dan Fineman. ขอบคุณครับ
So thank you, Philip. เหมือนคุณ Philip ผมขอ present เป็นภาษาไทยอยากฝึกภาษาอังกฤษ So Philip has given you everything you need to know about the entire world in just 15 minutes. I'm going to be taking a very different approach. I'm going to be focusing just on one country, Thailand, and instead of looking just at the outlook for, say, the next 6 to 12 months or 2024, I want to look at the longer term picture, a 3 to 5 year outlook. And what I'm going to be telling you is more optimistic than I think you've been hearing from most sources. And you heard that Kun Philip has a tactical overweight. That's something that I am in sympathy with. So first, why is it everything you read about and everything you hear negative about Thailand? Well, it's because we've been through a very difficult period. Let's look at the performance of local stock indexes in Asia since the pandemic started. This chart shows you performance of local indexes since 2019. Look at Thailand, down 24%, the third worst performer in Asia. Let's look at performance in dollar terms. It's even uglier. Thank God for Malaysia. If it weren't for Malaysia, we would be the worst performing market in Asia since the pandemic, down 29%. How about the currency? Not a pretty picture. Thailand, the baht, down 7% since the pandemic started. Not the worst in Asia, but very much in the bottom half. So this is why everyone is feeling gloomy right now, because they're looking at the past 3 years' performance. But what I want to show you is that the past 3 years isn't emblematic, isn't telling the whole story about Thailand's performance from a longer term perspective. And the past 3 years doesn't necessarily tell us about how Thailand will perform going forward. Let's turn our clocks back a little to the 10 years before the pandemic began. This chart shows you local currency index performance in Asia from 2009 to 19, the 10 years before the pandemic started. Thailand looks pretty good, 245%, third best in the region. How about if we look in dollar terms? Wow, Thailand, 307% returns in dollar terms in the decade before the pandemic. No one is even close to Thailand. Indonesia is number 2, but 43 percentage points behind Thailand. How about currencies? Well, the baht in the decade before the pandemic, up 17%. Again, no one even close. Number 2, 3, and 4 had only about half the returns of the baht leading up to the pandemic. And this wasn't just a financial market bubble. There were real fundamentals driving Thailand's outperformance. Look at inflation-adjusted ROE, return on equity. Thailand's number 2 in the decade leading up to the pandemic. Only Indonesia was better. How about earnings growth? Well, earnings per share growth, EPS, number 3, up 86%. That's a really strong performance. Well, what about structural issues? Thailand definitely has some serious structural problems. And if you attended the earlier sessions where Dr. Pipat went through Thailand's structural challenges, you know, it sounds pretty daunting. But I would like to tell you maybe we should view that glass as half full. And I think Thailand looks better in comparison to other countries than perhaps the media portrays it. Let's look at some structural issues. Everyone talks about how other countries in ASEAN, Indonesia, Vietnam, Philippines, also India, are growing faster than Thailand. But people are making unfair comparisons. Thailand is at a much more advanced level of development than these other countries. Thailand's per capita GDP, depending on where the baht is about $6,500 to $7,000 per person. Whereas in India, it's only about 2,000. So Thailand's 3 times richer than India. This chart shows you a like-for-like comparison of Thailand with the Philippines. I show you in these orange bars, Philippines GDP growth 2015 through 19. Why 2015 through 19? I want to look at the years before the pandemic, because when the pandemic hit, everything got distorted. And then I show you these blue columns, Thailand's GDP growth 1992 through 1996. Why those years? Because those years, Thailand's per capita GDP was the same as the Philippines 2015 through 19. So this chart shows you how fast Thailand was growing when it was at the same level of development as the Philippines. Thailand was growing much faster than the Philippines. So what this is saying is that a lot of the reason why Thailand is growing more slowly now is that it's climbed the income curve. When you're poor, it's very easy to generate growth. You take a farmer from his or her rice field, put her in front of a sewing machine in a factory, her productivity goes way up. Technology, you don't have to invent new technology. You buy, borrow, or steal it from more advanced countries. But when you get to Thailand's level of development in the middle income, you start to face the middle income trap. Economists talk about the middle income trap as the time when it becomes harder to generate growth because you've graduated from less developed to middle income. What about other markets? Well, here's Thailand compared with Vietnam. Vietnamese are supermen, right? Everyone tells us that Vietnam is going to take over the world, but look at Thailand's growth 1990 through 94 when its per capita GDP was the same as Vietnam's before the pandemic. Thailand was doing much better. Indonesia, similar story. Now here for Thailand, we're looking at 2004 through 2009. I would ignore these numbers because that was the global financial crisis, 2008, 2009. Before then, Thailand doing about as well as Indonesia. Everyone loves Indonesia now, but actually Thailand doing roughly as well as Indonesia when it was at a similar level of development. And India. Okay, here, when Thailand had India's per capita GDP, first 4 years it didn't do as well, but the last year it beat India. And actually this was a low point for the Thai economy. If you look at 1987, 88, 89, Thailand grew in double digits, way faster than India was growing before the pandemic or now. So the bottom line is, yes, Thailand is growing more slowly than less developed markets in ASEAN right now, but that's not all because Thailand is doing something wrong. It's because Thailand has gotten to a higher level of development. So, if the fundamentals of Thailand aren't that bad, if it performed so well before the pandemic, what has happened the past 3 years? Well, the economy got slammed. If you look at real GDP growth since the pandemic hit, the past 3 years, Thailand's the second worst in the region. Only Hong Kong had weaker growth, but basically neither of them have had any growth. And why is this? Well, it's really tourism. If you look at this chart, tourism receipts as a percent of GDP in all of Asia. We don't have 2023 data, but 2021, it was only 0.3%, whereas before the pandemic it was 1.1, 1.2% of GDP. Tourism has a long way to go to recover in Asia. Who is most vulnerable? Well, Thailand by far. No one even comes close to the dependence of Thailand on tourism before the pandemic. This is tourism as a percent of GDP in 2019. Who's number two? Hong Kong. Let's go back to this chart. Who are the two countries that have suffered the most from the pandemic? Hong Kong and Thailand. It's very much a story about tourism. So the message that I want to leave you guys with is that it looks very gloomy right now for Thailand because the performance of the past 3 years has been so poor. That, however, is due to the impact of the pandemic. If you go back before the pandemic, even though Thailand's structural challenges, demographics, loss of competitiveness were already in place, Thailand managed to perform very, very well. Now, I must leave you with a word of caution. I'm not saying that this year or the next 3 years, Thailand is going back to being the best market in Asia like it was before the pandemic. I'm not arguing that the baht will be the strongest currency like it was before the pandemic, but I do want to leave the message that the gloom and doom of the past 3 years is temporary, and the outlook for the next 3 to 5 years is better because the structural factors are less important for the performance we've seen recently than the after effect of the pandemic. Now with that, I'd like to ask Kun Philip to come back on stage. We have time to answer questions.
เมื่อสักครู่ก็เป็นในส่วนของการบรรยายนะคะในหัวข้อเรื่องของหุ้นไทยแล้วก็เราได้แตะถึงหุ้นในฝั่งของ emerging markets ในหลายๆประเทศในเชิงเปรียบเทียบด้วยค่ะระหว่างนี้น้องอาจจะ recap สั้นๆไวๆนิดนึงนะคะว่าอย่างตัวเซสชันที่ผ่านมาเนี่ยเราพยายามแสดงตัว stat ให้เห็นผ่านตัวเลขหลายๆอันนะคะแล้วก็โชว์ให้ดูว่าจริงๆแล้วเนี่ยในระยะที่ผ่านมาช่วงโควิดตัวหุ้นไทยอาจจะไม่ได้หวือหวามากนักแต่ว่าจริงๆตลาดช่วงที่ผ่านมาเนี่ยค่อนข้างโฟกัสเรื่องของ structural change หรือปัญหาเชิงโครงสร้างของประเทศไทยอยู่มากนะคะจริงๆแล้วเนี่ยเรียกว่าอาจจะ overreact ไปสักนิดหนึ่งโดยรวมเราก็ยังมีความเชื่อนะคะว่าปัจจัยเชิงบวกหลายๆอย่างในตลาดเกี่ยวกับหุ้นไทยเนี่ยยังคงมีอยู่ค่ะ So after this I would like to help you with the Q&A session เดี๋ยวลุงจะขออนุญาตช่วยในเรื่องของการส่งคำถามเข้าไปนะคะคำถามแรก the first question What would be the risk that US dollar will not weaken as you expected?
So yeah, what's the risk that the dollar doesn't weaken as much as we are anticipating? Clearly, you know, a lot of it's got to do with, in our view, to do with inflation and interest rates. So if suddenly inflation became a lot more sticky or reverses, and we had some data last week which suggested that inflation in the US was actually a little bit higher than people were anticipating. If that isn't a blip but becomes a new trend, upward trend, then I think rate expectations will shift dramatically. And we are seeing a bit of a shift already. You know, 2-3 weeks ago, maybe 4 weeks ago, the market was looking at maybe as many as 6 or even 7 interest rate cuts in the US. And today, you know, it's come down to maybe 5 or 6 times. So I think if inflation numbers came through higher than expected, then I think that could undermine the outlook for the weaker dollar. The other is obviously economic growth out of the US. Again, we're getting data where the US economy seems to be a lot more resilient than people were fearing. 2-3 months ago, people were talking about a hard landing in the US, i.e. a recession, and no one's talking about that now. Because the data, the macro data that's coming out at the moment very much suggests that US economy is doing better. So if that continues, then maybe the Fed doesn't, cut as quickly. So I'll say these are the sort of issues that we should be monitoring. But given that the Federal Reserves themselves came out with a so-called dot plot, which suggests that interest rates will be coming down over the next 3-4 years even, then I think directionally it's quite clear where we're going, at least at this stage. So maybe the magnitude of cuts is wrong. We don't have 5-6 cuts. Maybe we only have 3 or 4. But the direction, I think, is quite clear from what the Fed's saying, that rates are going to be lower this year than last year. Next year will probably be lower than this year. So with that, it suggests that a period of weaker dollar could still very much come through. Thank you.
Thank you. So the next question would be, what are the key positive factors investing in Thailand equity market and emerging market in 2024?
I'm going to take EM first.
Sure. So, why are we positive on emerging markets? Let's set aside the US dollar argument, okay? And just assume that's a bonus if it happens. I think first and foremost, the macro picture. I think I showed you a table on my first slide. GDP growth in emerging markets is expected to be stronger this year than last year, and that despite China slowing down. So EM ex-China economic growth is really looking to be much stronger at a time when US is expected to slow down, maybe not as much as originally feared. Europe is struggling. Maybe we'll get 0.5% growth. So I think there's a real divergence between EM and DM, so emerging markets versus developed markets in terms of economic growth. So for me, that is a positive already from a top-down perspective. But the second thing that we haven't shown in our presentation, but if you look at consensus earnings growth for emerging markets, EPS growth this year, I think, is forecast at 18%, and next year at another 18%. Whereas for global equities, EPS growth is at around 10% this year and next year. So really, you've got far superior earnings growth outlook for emerging markets versus developed markets. And the last factor, valuations. You've had an amazing 2023 for the US, especially the tech stocks, the so-called Magnificent Seven stocks. And they've done brilliantly, a lot better than I think most people anticipated. But because they've done so well last year, and I think they were up 44%, valuations are becoming quite stretched for US stocks, for developed market stocks broadly. EM, on the other hand, trading at 30-40% discount, not only to its history, but also to developed markets. So I think a combination of superior macro, far stronger earnings growth, and very attractive valuations very much underpin our positive stance on emerging markets.
For Thailand, I'd point to a few potential positives for the market this year. Number one, the political uncertainty from last year is largely dissipated. Not only did we have elections, but it took us several months after the elections to actually get a government. Secondly, related to that first problem, is that there should be less fiscal drag this year than last year. Because you had elections last year, you didn't have a proper budget in place, and the government in the second half of the year heavily underspent, whereas this year the government needs to catch up and accelerate its expenditures. I'd also note that because Thailand performed so poorly last year, both in absolute and relative terms, the valuations are looking better than they did at the start of last year. The final point I'd make is on sentiment. Sentiment towards Thailand is quite negative. If you are a contrarian investor, that's a good signal.
คำถามต่อไปจะเป็นเกี่ยวกับประเทศไทยนะคะเรื่องของ outflow foreign outflow ในปีที่ผ่านมาค่ะ Can you explain the reason behind foreign outflow from Thailand's stock market last year and at what circumstances we can expect the inflow this year or next year?
Well, to understand the outflows last year, we need to understand what was going on the year before in 2022. In the second half of 2022, we saw big inflows. Thailand was the darling of foreign investors in the second half of 2022 on the tourism reopening story. Then we come into 2023. Typically, in an election year, in the 3 months in advance of elections, Thailand underperforms because of the uncertainty of the outcome. And a lot of investors were spooked about the elections and they took their money out of Thailand. Then we had a lot of disappointing numbers. The tourism recovery didn't fully pan out as people had hoped. The Chinese haven't yet really come back. And the export outcome was worse than anticipated and dragged on the economy worse than people anticipated. Earnings did not rebound as people had hoped. So investors, foreign investors, took their money out. For them to come back, we need something interesting to happen, and I think that has to be earnings. We need the earnings cuts to end and to start to turn into upgrades.
Yeah, just to add to that, I think you're absolutely right, Dan. Earnings is critical here. If you look at consensus earnings downgrades last year for Thai market, I think it was down around 13-14%, which is roughly what happened with the share price. So the Thai stock market, I think, was down 15% last year. So, for the market to re-rate, for foreign investors to come back in, we need, as you say, Dan, earnings momentum to turn positive. At the moment, it's still negative. Okay, so it hasn't turned yet, but we need that to turn. When it turns, then I think you're going to start to see inflows because, with foreign investors, we're in January. Every year they reset, okay, because a lot of investors are institutional investors and their performance is measured on a calendar year base. So they may have done really well last year. Global equities did very well last year, but come January the 1st, everything's back to zero. And they need new ideas, okay? Thailand potentially could be that new idea, but you need earnings to come back first for them to start to refocus on Thailand. Thank you.
Thank you. Another question would be on sectors in Thai stock market. So there is an observation from our audience that Thailand stock market is exposed to old economy more than tech. So do you think that structural problem will weigh on Thailand's stock market and its performances?
Well, it's definitely a negative in the current environment where growth stocks, tech stocks, semiconductors are the stars globally. Thailand doesn't have that. But there's two things to keep in mind. One is that value stocks, and Thailand is much more of an old economy value stock market. Value stocks do have their outperformance from time to time. We did see that in 2021, part of 2022 globally. The other point is that with emerging markets, you sometimes don't have to follow the developed market sector lead. As an example, at the risk of stepping on Philip's toes, India has been a great performer. India does have an IT services sector, but as a percent of its stock market and as a percent of its economy, it's really pretty small. India is still pretty much an old economy and old economy stock market, and that hasn't stopped it from doing well. At the end of the day, earnings growth is earnings growth. And if you can deliver earnings growth from old economy companies, then your stock market is going to do well.
And I think this one is the final question for the session. So there's a question about Japan, Thailand, and India. Which one do you think would be the best performer in 2024?
Shall I take that?
Yeah.
Well, officially, we're underweight Japan. So I think, Japan had such an amazing 2023, and it certainly started 2024 very strongly. We just don't think that's sustainable. I think the early gains have already been made. So we're skeptical of how much further that has to go. In terms of India, as Dan said, clearly, and you saw in Dan's presentation, clearly this is a structural growth story. It's, a low penetrated story. It's got many years of structural growth, which, I fully subscribe to it. I think, if you look around the world, there are not many countries where you can say you're going to get 5, 6, 7% GDP growth over the next 5 years to 10 years. India is one of the few truly high growth economies left, I would say, of a meaningful size, obviously. So I do subscribe to that angle, but they're really expensive. The market's on over 20 times PE. A lot of the good news seems to be priced in. The other day we had HDFC reports, weak numbers. And that suddenly brought down the market for a day at least. The point being, a lot of positive news are being priced in terms of the Indian stock market. You need things to completely work out. You've got elections as well, right, in April. Modi is probably going to get re-elected, which is good. You want continuity. But certainly, whilst I would support the multi-year view, you got to ask yourself how much of it in the short term is already in the price. So that leaves Thailand, where from our wealth management side, the CEO office, we've got a set index target of 1,600 for the end of the year, which suggests upside around 13%, maybe 14%. Sure, there are risks, and the number one risk for me is less top down, but more bottom up, and that's earnings. We're at the start of the fourth quarter reporting season, and certainly banks' results so far have been pretty mixed, to say the least. So we need bottom-up earnings upgrades to come through, and if it doesn't come through, the risk is, in the worst case, is that the market there's a drag on the market. But certainly, consensus looking for, I think, 13, 14% EPS growth at the moment. They're looking for 3.5% dividend yields for this year. So if these numbers do get delivered, then I think, you could get total returns around 15, 16%. And that would certainly make it one of the best performing markets for this year, if that is achievable. So to answer your question, we would support Thai stock market for this year. We've got a tactical overweight within the wealth management team. And certainly, we don't see any reasons to change that view at this stage.
Thank you. We've got another question coming in, and I think it's pretty interesting because we discussed about the returns, but this question is about the risk. So please tell us any downside risks to Thai equity.
Well, Philip said that earnings are a key risk factor. If the earnings don't rebound, if we get more earnings cuts, that clearly is a problem. If we turn to the macro picture, if you attended the first session with Dr. Pipat, he noted that Chinese tourists have come back very slowly. Tourist arrivals from China are only about 35, 40% of the pre-COVID level. What if the Chinese never come back? We're all hoping that it's just a matter of time. Eventually they come back. But what if China no longer is an exporter of tourism to the extent it was before the pandemic? That would clearly be a major problem for Thailand. Secondly, more cyclically, Thailand, despite its move into tourism, it's still a highly export-oriented economy. manufactured good exports are still critical to our economic health. And for that reason, we need global trade to do better this year than it did last year. We can't have another year where exports decline by 5 to 10 percentage points.
And one to add from my side, oil price. So I remember 2-3 months ago when the oil price was approaching $100, and the World Bank even came out and said if the Middle Eastern problems with Hamas and Israel became a full-blown regional conflict, oil price could hit $150 or something scary like that. You know, from a Thailand perspective, you know, the big worries there were on the currency. On the one hand, I think the baht was around 37 at that stage. But also bear in mind that obviously the government subsidized a lot of the higher prices, especially on the diesel front. There were worries on the fiscal front. So bond yields were elevated. I think the Thai bond yield was 3.3%. These are all major negatives, you know, for the Thai stock market, whether in terms of, you know, foreign investors, one thing they don't like is currency risk. So if they have a country where the currency is weakening, they will not come close to investing in that country. They want currency stability. And secondly, if bond yields are going up, it implies cost of equity is rising. That weighs on valuation multiples. So for me, another risk in addition to what Dan said would be oil price. Monitor that. At the moment, it seems okay. It's around $78 to the barrel. We think it's going to remain pretty subdued, especially if China growth is weak. But if suddenly that turns around and goes back to the 90s or approaching 100, that will be a headwind for the market.
Thank you so much, Kun Dan and Kun Philip, for the presentation and very informative session as well. ยังไงขอเสียงปรบมือให้กับวิทยากรทั้งสองท่านของเราอีกครั้งหนึ่งค่ะ